Hello, everyone. My guest today is Tamas Cser. Since 2015, he's been building Functionize, which has been delivering the first AI-powered autonomous cloud-based testing platform to automate the painstaking process of testing web applications. Tamas, you ready to take us to the top?
Absolutely, ready to go.
All right. So, should we think of this like kind of Rainforest QA or Sauce Labs, or kind of what space are you playing in here?
This is really the next generation automation platform. If you think about Rainforest or Sauce Labs, it's traditionally either still really manual or very, very script heavy. And what we're trying to do here is really take big data and computer vision and natural language processing and make testing truly the next generation AI ML driven, very, very low human touch required approach.
Okay. So, tell me a specific customer that right now has this deployed and how they're using it. What cost savings have they had? What they switch from?
Absolutely. So we see basically a couple of different scenarios where we see customers either dropping existing scripting solutions, some that have dropped Rainforest that we've taken.
Yeah, Tamas, sorry, can you give a really specific example, like actually name the customer?
Absolutely. Zenefits, for example, is a customer that we took. They were a customer of Rainforest and moved over to Functionize and have been successful ever since. And we're excited to have them as a customer. Certainly, we see greenfield opportunities as well as customers that have tried scripting, such as Salesforce.
Actually, Jay was just on the show 4 weeks ago. He's obviously leading a nice turnaround there at Zenefits, but help me understand what they were able to save or get with you they couldn't get from Rainforest. Do they have to have like less developers, committing code or doing automated reviews, or where do they save money or time or energy?
I think it's primarily speed, it's expertise required, and the overall effort involved, basically to get automation in place.
Okay, and so you're making testers more efficient, or are you replacing them?
We don't necessarily replace testers. What we see generally in a deployment is customers generally struggle for expertise. So people generally just get more productive. There's not enough coverage in place, so they get to do more coverage, more work, more productivity, faster time to market.
Mm-hmm. Most developers who I've interviewed in this space, the biggest issue is actually making sure you write all the tests so you have full coverage on critical pieces of the application. And a gap in a test or a test that breaks or things like this obviously then makes things not work so well. So are you essentially plugging those gaps, helping make sure those things do not happen?
Absolutely. So we plug the gaps in coverage, we plug the gaps in maintainability. So as testing scales out, it's a huge challenge to keep that up to date. And those are the main key challenges that we help our customers, basically, as you were saying, plug those gaps.
Okay. And now what's your model? Are you pure play SaaS or professional services plus SaaS or something else?
We're a pure SaaS model primarily. We see some demand certainly around professional services. We have done some of these, but we're looking at partners to take that burden, if you will. We're primarily focused on product.
Okay. And give me a general sense here. I see your pricing. You have a lot of different kind of cohorts. We don't have time to talk about all of them, but on average, what's the sweet spot? What's the customer going to pay you per month for your tech?
So we're looking starting at around $5,000. We're primarily focused mid-market to enterprise, and we really are a high value, high impact type of product where we really don't come in and don't start playing unless there's a serious business problem to solve.
Okay, so all customers basically paying north of $5,000 a month, call it $60,000 ACVs.
Right now, that is our sweet spot, and that's what we're focused on. I think as we mature as a company and as a product, certainly other type of models, I think, is something that we're talking about or considering. But right now, that is absolutely the sweet spot and what we're focused on.
When you look at your historical pricing experiments, though, did you move down market or up market? In other words, is that $5,000 a month? Is that a fair average across your current paying base, or are a bunch of them on cheaper plans because of early pricing tests?
To be perfectly honest, last year we were starting at $10,000. So this has been a drop, but I think in the previous years we started much lower. So this is really a question of maturity, and as the company evolves, us finding the right one. So we kind of started much lower and then moved much higher, and kind of are now coming down. And as we find more productivity in our product and we understand our customer base and getting more efficient in deployments, we can start introducing lower tier pricing and make that successful.
When did you guys write your first line of code for the MVP?
Oh boy, that's probably early 2014.
Okay, and how much did you and your co-founders sink into kind of product development before your first dollar revenue?
We were probably 2 to 3 years in before our
Okay.
first revenue.
Can you quantify that? I mean, are you talking like $1 million into the platform before revenue, or?
Oh, that's a great question. It's it's slightly difficult to quantify because it was spun out of, I primarily did a lot of development myself and spun out of a previous company that was successfully running, was cash flow positive, and that I ran for about over 10 years, and we did development, and it kind of started leveraging existing resources. There was not really a solid dollar amount assigned to that, and it really started as a pet project to solve our own internal problems. And
if you ignore your sweat equity, though, imagine maybe you paid some developers, contractors, designers, folks like that. Can you try and quantify what that cash?
It's millions of dollars for sure sunk in before we saw the initial dollars start returning.
So you're really rich, or you raised capital on day one?
Cash flow positive company, successful previous company that enabled me to dabble and take the company and bootstrap it to quite far. And then once we had a working product and we saw our early beta customers, we always charged something. Started charging, I think, $500 per customer early on. Then we were able to raise friends and family around, and then from there things kind of took off organically.
And how much today have you raised all in?
We raised about 60 million all in.
1.6 or 60?
Yeah, 1.6.
1.6. Okay. And I mean, why did you you don't raise unless you have to because you get diluted, right? Why did you absolutely have to take that dilution? Why couldn't you keep bootstrapping this with your own money?
I think it primarily comes down to what type of company do you want to build, and market conditions. So I think that this is a huge market with a huge opportunity. And when I was considering the raise or not raise question that I think is on the mind of a lot of founders, it was very clear to me that the market opportunity and the timing meant that we have to move quickly. And what the capital is allowing us to do is just to move and do that, faster, more iterations, and more basically trial and errors that are faster. So I think time to market for us and really the sweet spot solution and land grab, I think, is worth the dilution, if you will.
And I mean, you've done this before. You had a successful company since prior to this, so you understand cash management. When you talk about being aggressive, I always like to understand what amount of burn founders are comfortable sleeping with at night. So you've brought in 16. You're scaling the company. I mean, are you cool with like $100,000 burn or $1 million burn per month? Where do you trying to optimize that?
I think like every other company in Silicon Valley, we're looking at probably 18 to 24 months runway where we are very focused on very specific milestone that we want to reach. And if we reach those milestones, we're comfortable increasing the burn and also going after opportunity. So we see a lot of opportunity, and that's across the board. And for that, I think we are a little bit more aggressive than we initially thought. And that's across the board. I think customers, partner opportunities, and again, just if you look at the market horizontally. So it's a very difficult question. I think, what is the right amount of burn? And it's something that we're adjusting as we go.
So just to be clear, you're saying when you think about raising based off your historic expertise, you like to raise for between 18 and 24 months of runway.
Yeah, I think that's something that works pretty well. I think you adjust. Things do not turn out the way that you imagine. I think that conditions change very quickly. I kind of feel like every 3 months the company is a new company and conditions change. And
yeah, I guess that's what I'm asking though is again, you're trying to be aggressive. You raised the Series A on March 5th, 2019 for $16 million, right? If you and your pro formas and in your deck are saying this is going to cover 18 months of runway, you basically have a forecast that takes you up to almost $800,000 a month in burn. I'm just trying to quantify when you say aggressiveness, it's a land grab, market share. These are all critical words. I'm just curious how aggressive you're willing to push it.
Well, I wouldn't say I wouldn't go quite that high. I think that we're going to probably be a little bit more conservative than that. But it's something that, again, I think if you look at a $10 to $12 million raise, so we had some convertible notes convert into our Series A, obviously, and taking up to the total amount of 16. So just the way that I look at it is, let's say, anywhere between 250 to 500K, I think is a reasonable burn rate for a company of our size and opportunity.
That's helpful to understand. Yeah. So 2014, you launched the company. You're coding for a couple of years. You said your first dollar revenue was 2015.
No, I think we 2017. So the
17.
first line of code was 2014, but it wasn't in the form of like a concentrated effort to do anything. Like I said, it was let's try to solve a problem for ourselves internally, and started working on it myself. And it was interesting, and I learned more, and I got more curious about the market and the opportunity. So it was very organic and very slow early on. And we founded the company late 2015. Our first dollar of revenue, I think, was late 2016, like early 2017.
So since 2017, so you call it 2-3 years now. How many customers are you serving now today?
So we have about 3,000 customers that we're serving today. We're obviously, again, adjusting and learning more about the market, who are the right customers for us. So, some of the early customers that you have, I think, and we're kind of at that stage, you kind of go through and look at that, and you learn maybe they're not quite the right customers. So there's a little bit of shedding going on and focusing on acquiring the right customers for us.
So you've manufactured some churn. Look, I think churn can be healthy sometimes. When you look at your revenue churn, not logo churn, but revenue churn historically last 12 months, what would you pin it at?
Oh, it's really difficult. I would say that the largest churn that maybe, 10 to 20% would come from what we call on-prem deployments. We kind of played around with that and ventured into deploying our solution on-prem.
You mean private cloud or physical servers on location?
Physical servers on location.
Wow.
And it's probably the largest dollar churn that we're seeing currently.
Okay, so got it. So just to be clear, if you had $100,000 a month in revenue a year ago, you're saying because of these tests, about $20,000 a month would have churned from that.
Yeah, I would say that sounds about right.
Okay, fair enough. Now, do you? I'm not sure where you're at company stage wise, right? It sounds like this is a muscle you might build in the future. Do you have a strong expansion muscle right now where you can double and triple contract values year over year, or no? That's still something you're building.
What we're really focused on right now is not to push the contract values, because we kind of proved that out last year, and on the back of that, I think we're much more focused on repeatability and velocity. And really just getting really efficient at identifying the right type of customers and onboarding them successfully. And that is the primary focus for the company right now.
Got it. Okay. So 20% gross churn, it sounds like no or little expansion. So about 80% net revenue retention annually.
No, we absolutely do have expansion across the board. It really means that the churn is really more of the opportunities that we walk away from. Certainly, like every other company, we
does the expansion fill that churn hole though? What is your expansion annually? 10, 20%?
Yeah, so I would say that not counting on-prem, then the expansion easily fills the churn.
Okay.
On just the normal contracts.
Yeah. Okay. Fair enough. And then talk me through your team today. It sounds like this is an engineering heavy tool. What's your team size say, and how many engineers?
So we have about 22 engineers right now, and certainly still looking to expand and get real rock stars on board. So
what's the total team size though? Yeah,
so we have about 35 right now in the U.S., and then we have an office in Noida. We invest quite a bit in data labeling and gathering data. That's really the cornerstone of our technology.
Where's that?
So that's in Noida, in Delhi, India.
Really interesting. Okay, do you have a co-founder from there?
No, I don't. But I have a super strong technical / business lead over there.
Okay.
That I have a 10-year relationship from my previous company, a super smart guy, Encore, who's been again with me for since the beginning of the journey probably, and overall as a business technical relationship well over 10 years.
So 35 on the team, 22 engineers. How many quota carrying sales reps?
So we have 3 quota carrying sales reps.
Okay, so something to scale. And when you factor in their commissions and everything else related to your marketing, how aggressive will you be on a $5,000 a month customer? Will you spend the full $60,000 up front to acquire them?
So CAC is really difficult for us to compute because it's moving quarter by quarter. If you look at last year to this year, especially as we adjust our ACVs and where we start. So I would say we would be comfortable spending $60,000 because it's a land and expand model. As we get into an enterprise account that has expansion opportunity horizontally, in business units as well as growing an existing business unit. I think that's certainly a number that we're comfortable with.
What's your payback period today, though, across all cohorts? Are like six? Are you optimizing for 6 months, 12 months, 18 months, 24 months?
We were about 8 months at the beginning of the year. To be perfectly honest, again, we've moved the model very quickly. We need to see a little bit more in terms of, for that to play out, for me to give you something that's meaningful.
Yeah, be more aggressive there. That's good. Okay, and then look, so 36 customers, $5,000 a month ARPU. That puts you about $180,000 a month right now in revenue. Is that about right?
$180,000 a month for revenue, as in.
Yes, you mentioned earlier your ARPU was about $5,000 a month, and that you had 30. You said 36 customers. 36 times 5,000 is $180,000 a month.
Yep. Yeah. So I don't have the exact numbers right here, but it's close, I think.
Okay. And then take me back exactly a year ago. Do you remember where you were then?
Yeah, absolutely. We were a third of that, maybe less.
Okay.
Yeah, we were
so good. So kind of $60,000 a month about a year ago, 180 now. During that time period, you experimented with a higher price point. You did some on-prem stuff. You're now moving away from that, a little bit lower price point, and that's how you think you're going to scale.
Absolutely. I think that, again, it's velocity. It's getting the right starting price point for our customers and finding the right customers, and repeatability is what we're focused on.
Very good. All right, let's wrap up here with the famous 5. Number 1, what's your favorite business book?
That's a great one. I know there's so many great books out there.
Pick one.
I don't know.
If you don't have one, just say none. It's fine.
Okay, yeah, none.
All
there
right.
You go.
Number 2, is there a CEO you're following or studying?
Again, many great CEOs. I mean, obviously, I love what Musk is doing. I think that just the risk profile, just the vision, just what he takes on. I think it's absolutely inspiring. So love what he does. Love what he's doing with kind of autonomous driving.
Number 3, what's your favorite online tool for building your company?
Oh man, I mean, we use a lot of Slack. That would be
number 4. How many hours of sleep you get every night?
I try to be good about that. I try to get 7, 8 hours of sleep a night. That doesn't always happen, but I try to be good about that.
And how old are you?
I'm 43 years old.
43. And Tamas, what's your situation? Married, single, kiddos?
I am married with 2 kids.
Oh, wow. You have your hands full. All right. Last question. What do you wish your 20-year-old self knew?
Oh, gosh, many things. I mean, how do you pick? So many things. Be aggressive. Be more aggressive early on. I don't know. I was pretty aggressive, but yeah, I don't know. Just go for it. Just don't worry about things. Try, learn, and do your best.
Guys, functionize.com, helping dev teams write better tests, more efficient tests, and scale their deployments faster. 36 enterprise customers right now paying about $5,000 a month, $180,000 a month right now in revenue, up from $60,000 a month just a year ago. First line of code in 2014, first customer 2017, call it a couple million in the MVP. Now scaling, 16 million raised, comfortable with, call it $250,000 to $500,000 a month in burn as they look to scale their team of 35 people, currently 22 engineers, 3 quota-carrying sales reps, and a data team in Delhi. 20% churn. Expansion fills that gap, call 100% net revenue retention with the 8-month payback period right now on most of their new customers. Happy to push that up a little bit higher as they look to scale. Tamas, thank you for taking us to the top.
I really appreciate it.